Hi, this is Jim Sackman, your Focal Point Business Coach, and this is another of our Success Friday videos. And again, we're in our series called Financing Your Business, and this time I want to talk about the path for companies that are headed to an IPO or a sale instead of an IPO. And those are an initial public offering, which is the first time you issue stock to the public markets. These are well-known big companies, often end up this way. You'll hear about them in the news, and very often they're more like product companies than they are like service companies, and that has to do with scalability. So most of the time when you're offering a service or actually physically delivering a service, then every time you need to deliver more service, you need to add more people. And so your scaling is associated with the size of your staff. Product companies or sometimes marketplaces can scale much more rapidly. Let me use an example of a marketplace, which is Uber, where essentially it matches drivers and riders, and it doesn't provide a service. It basically provides that connection between the two people. Or a product company like back in the old days, Cisco, where you don't need to necessarily add people for every transaction you're going to have. Uber needs more drivers, but its software doesn't need more people to run more drivers and more transactions. So because of that, what you're going to find is these kind of generally what are called VC-backed startups are going to be product companies or marketplace companies, and not as often are they service companies. There are cases where they can be, but they're much more rare. Now, if as you're going into one of these companies and you're hitting this rapid growth phase, the business is looking to the point where it's going to be able to become profitable and potentially very profitable. It often needs more money to ramp up production or ramp up its marketplace to be able to grow to the kind of scale where it's going to be very profitable. And so we've talked in the past about an A round, or that initial round where a valuation is set. Now we're going to talk about the subsequent rounds, the B, C, D, E, A, F, G, H, blah, blah, blah. If you get out to an F or G, that's probably a problem, but B rounds, C rounds are quite typical. And then what those are basically additional capital raises where you're selling stock of the company to normally new investors as well as some of the old investors, and there's a potential for an up round or a down round. And an up round is the pre-money valuation of the transaction is worth more than the post-money transaction valuation of the last round. Now, what does that all mean? Pre-money is the value of the company before you take in any new share money, and post-money is what's thereafter. So right as you take it in, essentially pre-money plus the value of the cash you took in equals post-money. So if it continues to grow, you can see that to raise $10 million on an up round is less, giving away less of a percentage of the company than it is on a down round. So that's how that works. People will know how to do this. If they're in that zone, they'll be out there working with VCs and trying to attract more money. And this is the way that people build and raise capital until they can actually offer shares to the public to issue money. So Jim Sackman from Focal Point, change your business, change your life. Have a great day.